Well, good afternoon, everyone. My name is Bill Fox. Welcome to our fourth quarter of Beyond the Noise. Our goal at the Fox Alliance is to offer insight into big economic themes. Our topic for today is ballots and budgets or business, economic and market repercussions of presidential elections. Before we get started, I just wanted to say, in my many years of being in this business, I found that the most frequent question or concern for clients is whether there will be a Democrat or Republican president in office and the effects of that on their portfolio. So today we'll take a historical look at how markets perform during a presidential election. What is the most likely outcome of this election? What would be the policies and potential impacts of a Harris or Trump win? Our panelists will speak for about 30 minutes, and we will have time for questions after that. Our chat feature is not allowed by compliance, so if you do have questions, please email me at bill@thefoxalliance.com. Our presenters today will be Max Clark, Laura Cooper, and Josh Renfro. Max will be our first presenter. Max, it's up to you.
I appreciate it, Bill. Thank you for that introduction. We've got a lot of great information to cover with you guys today, and I appreciate you taking the time to join us. I want to be clear as we get started here about what our objectives are in this presentation. We are not looking to endorse a particular candidate or to communicate, that we are looking or, anticipating one particular candidate over another being elected. Our sole objective today is to help you as our clients who are investors in the U.S. market and also members of the U.S. economy, help you guys understand how politics impacts the markets and the economy, how elections might influence markets' performance, and then ultimately how certain policies that are ultimately passed may impact markets first and the economy after that. So that's our objectives as we get into things today. Let's start out by first taking a look back at history. Bill mentioned at the outset that one of his most frequent questions has been, how does particular parties being in power influence the market and the economy? So let's answer that question first. Let's start by taking a look at the S&P 500 returns on an annualized basis, looking back to 1951 through 2023. This basically started with the 82nd Congress. And what's interesting is if you look at this from just who is in power in the White House, Democrats on average had a 11.5% rate of return annually. Republicans on average had a 7.1% return annually. So if you're a Democrat, you might look at that and say, see, look at this. Democrats have a better result. If you're a Republican, you say, well, maybe I don't agree with that. But that's just taking a look at the leader of the White House. Let's take a look at Congress. We see some different results. If Democrats have control of Congress historically over the same time period, we've seen about a 6.7% rate of return per year. Republicans, about 11.0% rate of return per year over that same time period. So the data is different in this case. And what I think is most interesting is if you take a look at the results during a split Congress, where you've got one party in control of Senate, one party in control of the House, you actually see better results. And I think that's real insightful, because the reality is I think markets prefer when the government isn't involved in anything. If we aren't seeing changes to current laws, the markets and the economy can move forward and do their thing. Oftentimes, intervention by governments can create some volatility in the markets. Now, one of the things that I think a lot of people think or feel in their heart is, hey, the particular party that I align with, if I invest only when they're in power, I'm going to have better results. Well, let's take a look at this just by looking at who's in control of the White House. So if you only invested, if you're a Democrat-leaning person and you only invested over the last, call it 70 years, when Democrat presidents were in power and you invested $1,000, your return would have been $61,000, or that $1,000 would have grown till now to about $61,800. versus Republicans about 27,400. And we're just looking at the data here. What's interesting is if instead of investing during your preferred party's control, if you remained invested for the entire time, you had a significantly different result. It wasn't less than 100,000. It was almost $1.7 million. And what we really want you guys to take away from this is that you really can't draw any conclusions about one party versus the other solely being in power, being better or worse for the market. The key thing is staying invested over the longer term and focusing on profits and the economy and those types of things that we help you guys navigate. Now, are there exceptions to this reality? Are there some things that maybe have greater influence on the market at times? And the answer is yes. There are a few things, and this is by no means an exhaustive list, but there are some exceptions to that reality that you can't draw any conclusions. And it is that when certain policies are passed, whether that's adding a certain policy or removing a certain policy, that can have an outsized impact on the market and ultimately the economy. So, for example, if you have a particular party or Congress that institutes or implements tax cuts or increases, that can influence the market and the economy. This would be a good example, most recently, the TCJA, which is the Tax Cuts and Jobs Act that was passed in 2017 and ultimately implemented in 2018. That had a little bit more significant impact on the market and on the economy. Another example might be price controls. If you have a time period where price controls are implemented, meaning that you can only raise prices up to a certain point, that can hamper competition, that can, in many cases, destroy supply, creating shortages, those types of things. If you look back to the World War II, there were some price controls that were put in place at that time. And it drove a lot of smaller companies out of business and created razor-thin margins for those that stayed in business. They were able to stay in business, and they chose to do that because in the end, they believed that those price controls would be removed. They survived and were able to continue on. But price controls can be a policy that influences the market, whether you're adding them or taking them away, positively or negatively. Another example of this exception might be tariffs. So tariffs can really function effectively as an additional tax on us as consumers in the US. So if you add tariffs, that can function as essentially a tax increase. If you remove tariffs, that can function essentially as a tax decrease. I'm not here at this, on this slide to particularly promote or talk against tariffs. We're simply looking at their potential impact on the markets and the economy. The last one that I'll mention here would be major structural changes to the tax code. If you've got business and investors operating with a certain understanding of the way things operate, and then that's changed abruptly, that can have a major impact on the markets and the economy. Perfect example of this, we all remember what happened back in 1987 with the savings and loan crisis, where the law was changed abruptly, where basically the depreciation schedule was changed, and that resulted in a pretty significant sharp downturn in the market and certainly impacted the economy going forward. So ultimately, when we're asking the question, does a political party being in power influence the market? The data suggests that you can't draw a conclusion on that. There's not a clear principle that can be drawn there. If Republicans are in power, it's better. If Democrats are in power, it's better. We can't draw that conclusion. The data does not support that. The key thing is making sure that we are invested over the longer term. What influences things more is the policies that are ultimately passed and implemented, which is why in the latter part of this presentation, when Laura and Josh jump on to have their piece of the presentation, they'll be looking at some of the policies that are proposed by both candidates. And we'll be looking at how those may potentially impact the markets and the economy. But before we do that, I want to shift over and take a look briefly at what the potential outcomes of this election might end up being. I know that's on a lot of people's minds. We're, 8 or 9 days away from the election. And here's kind of where things stand at this point. If we were to take a look at all of the states out there and all of the electoral votes available, you guys know that a particular candidate, in order to win the election, needs to win 270 electoral votes. So basically what we did on this map was we said all states that are leaning Republican or solidly Republican, we assume Trump wins. All states that are leaning Democrat or strongly Democrat, we assume Harris wins. That leaves essentially 7 battleground states. We're all familiar with them: Nevada, Arizona, Georgia, North Carolina, Pennsylvania, Michigan, and Wisconsin. So let's take a look at the polling in those states. Now, I want to be clear about polling. Polling is certainly something that is not an exact science. And we can obviously have polls that are more left-leaning, polls that are more right-leaning. And if there's anything we've learned over the last several presidential elections, polls are not always right. But what we're taking a look here is information from Nate Silver. And Nate Silver is a highly respected political scientist who has really staked his career on making accurate predictions about elections. He does his best to be nonpartisan. For example, if there's a poll that might lean more Democrat in who it's coming from, he's going to try to adjust for that, and really tries to emphasize more polls that are coming from a nonpartisan source. He was ranked previously in the past several years as one of the by Time Magazine is one of the most 100 influential people in the world. So what we're looking at here are not just random polls. These are Nate Silver's compilation of kind of his best estimate of where the polls are currently. And we're looking at the 7 battleground states. So you can see that they're all pretty tight, but it really comes down to 3 or 4, because North Carolina, Trump's leading by a little over 1%. Georgia's leading by a little over 1%. Arizona's currently about 2%. Let's assume, just for purposes of our discussion, that those states that have 1% or more lead by one candidate go to that candidate. So in this case, Arizona, North Carolina, and Georgia go to Trump. What does that leave us with? That leaves us with Republicans, or Trump, with 262 electoral votes, and Democrats with 226 electoral votes. So even if Trump wins Nevada, which represents 6 electoral votes, that puts him to 268. That's not enough to win the election. So it ultimately comes down to really these 3 states: Pennsylvania, Michigan, and Wisconsin, what they kind of call the blue wall. And really, whoever wins these states, and ultimately, Trump just really has to win one of them in order to have victory. Generally, whoever's going to win these states is most likely going to win the election, which is why you see Trump and Kamala Harris spending so much time in these states. What I think is interesting, I'll just make a kind of quick aside. This election, no matter what way you cut it, is shaping up to be a very close election. When the results are ultimately counted, we might actually find ourselves with a landslide victory one way or the other when it comes to the electoral votes. And the reason is because if one candidate wins one of these blue wall states, it's most likely that all of them would end up going towards that candidate. So while it's a very thin margin in all of these states, we might find ourselves in a position where one candidate or the other may end up having over 300 electoral votes, that type of thing. And it looks like it's a landslide victory, despite the fact that it's a very narrow win. Now, here's one last thing that I'll point out. Nate Silver takes a look at all 7 battleground states and their influence on the election. Take a look at Pennsylvania right there at the top. The second column shows the chance of Pennsylvania tipping the election. He ranks that as a 30% likelihood that Pennsylvania influences the election. Look on the right-hand side. If Harris wins Pennsylvania, she's got an 88% chance of winning the election. If Trump wins Pennsylvania, he's got an 89, almost 90% chance of winning the election. Again, this is why we see Trump and Harris spending so much time in these battleground states. So as we're looking at the results of the election going forward, keep an eye, obviously, on Pennsylvania, Michigan, and Wisconsin, as those are going to be pretty important states going forward. All right. If we were to take a look at Nate Silver's prediction for who's going to win the election at this point. Again, he does his best to be as nonpartisan and eliminate partisanship from the data that he's evaluating. And he has been very accurate historically. It looks like the momentum currently is with Trump. He's got him at about a 55% chance of winning and Harris at roughly a 45% chance of winning. Again, you can see that this can change rather dramatically depending on the particular time. But currently, that's what his prediction is. Now, the other thing that we really have to think about as we enter this, enter election day is whoever wins, it doesn't mean that they can do whatever they want. It really comes down, one of the most important factors to consider here is what's going to happen with Congress. Because obviously, if you win the White House, but you don't have control of Congress, there's only so much that you can do. So let's take a look at the congressional polls. Again, polls are certainly not, infallible, but we can just kind of get an idea of where things stand currently. So in the House, there are about 201 seats that seem like they're going to go towards the Republicans, about 192 seats that it seem like they're going to go towards Democrats. And there's 42 toss-ups. Remember that you need 218 seats for a majority. So let's just assume for purposes of this discussion that they split the 42 toss-up. Democrats win 21, Republicans win 21. That leaves the Republicans with a 222 seat count, with the Democrats with the rest. Basically a 4-seat majority. That's a very thin majority in the House. What about the Senate? In the Senate, assuming that things kind of play out the way that they're looking like right now, Republicans may end up with a 2 or 3 seat majority in the Senate. Again, we'll see how the election plays out, but that looks how things are going to play out. So I think the most likely outcomes here are if Harris gets elected, she's most likely going to be dealing with a very slight majority in Congress by Republicans. If not, it's going to be a very slight majority for Democrats. If Trump gets elected again, he's probably going to be dealing with a very slight majority in Congress. Now, what does that mean? When you have very narrow margins in Congress, what does that mean? That means that the most moderate person in both the Senate and the House becomes the most powerful person. Because obviously, to get policies passed through Congress and ultimately get to the desk of the president to sign, you have to have the support of your party. And the most moderate person, because you need every single vote, the most moderate person becomes the most powerful. We saw that over the past couple of years, over really Biden's administration, where Joe Manchin and Kristen Sinema became some of the most powerful people in Congress because they were the most moderate. You had to get their support if you were going to get things passed. So this is an important thing to remember about really the brilliance of our political system, the checks and balances that we have in our government, and how just because one party gets elected doesn't mean that they're going to have the ability to do whatever they want. Now, we're going to shift over and take a look at some policies that we believe are, if they are implemented, and these are policies that have been proposed currently by Kamala Harris and Donald Trump, but if they are implemented, we think they would have the greatest impact on both the markets and ultimately the economy. And what you'll see here is on the right-hand side, we've listed the likelihood, and think of this as least likely being 1, most likely would be 5. So this is kind of on a scale of 1 to 5. And what's really influenced predominantly are choices about the likelihood there would be what I was just talking about with Congress. Because there's such a narrow majority for whoever wins in Congress, some of these things, which seems like they would be a layup, may actually not be that case because either they're more on the far right side or on the far left side, and you're going to have a difficult time really pulling those moderate people to vote for those policies. So what Laura's going to do, she's going to kick us off by taking a look at these policies that Harris has proposed and how those might impact the markets in the election, or sorry, the markets in the economy, if they are ultimately passed. And then Josh will close us out by taking a look at the policies promoted by Donald Trump. So Laura, I'll pass it over to you.
Awesome. Thank you, Max. Thanks for that historical overview. So as Max mentioned, I'm going to focus on four proposed policies for the Kamala Harris administration. So the first we're going to take a look at is raising the corporate income tax to 28%. We have this at a likelihood of 4. So on the scale of 1 to 5, on the higher side of likelihood, our current corporate income tax is 21%. And that's the tax we've been under since the TCJA was passed in 2017. So before that, the tax rate was 35%. So we dropped about 14%. And this proposal would take us halfway back to that 35%. The Wharton School of Business did a study that estimated this would cost US companies about $1.1 trillion over the next 10 years, adding $1.1 trillion of revenue to the government. But if we look at all of the policies that have been proposed for the potential Harris administration, that would lead to a $1.2 trillion increase to the national debt over 10 years, above how much the national debt is expected to already increase. So even though this would add revenue, with all the other policies in place, or all other policies proposed, this would not really make a dent in what is becoming a ballooning national debt issue. And if we look at the potential implications here, the first is that this can lead to interest rates on treasuries remaining higher for longer. If we think about why that's the case, U.S. treasuries, so U.S. Government debt, has been considered one of the best assets to invest in as far as risk. If you're looking for a low risk investment, investing in the US government has been one of the best places you can do that. As our debt continues to increase, we become less and less attractive from a risk perspective. One, our budget, a larger part of our budget goes towards paying the interest on that debt. It becomes a much larger financial burden to us as a country, and things don't look as great as they did when the debt was lower. And so for that investment, for the increased risk of that investment, investors demand higher yields, and that leads to higher interest rates on treasuries. When we think about this from an economic standpoint, especially long-term, that leads to higher consumer debt interest rates, higher mortgages, higher car loans, higher small business loans. That can have a massive economic effect. We've already seen what 18 months to 24 months of higher interest rates can do to an economy. Think about that over a 10-year period. That can have a massive effect. Also, slower growth over the next 10 years. This is a theme for the majority of the 4 proposals that I'm going to go over, is slower growth. If companies have to take their earnings and pay on average about $120 billion per year across the board to the government, that's $120 billion that doesn't get reinvested into companies and can slow down growth over time. The second proposal here is looking at an increase in long-term capital gains tax. This is also a likelihood of 4, putting it on the higher likelihood scale. Our current long-term capital gains tax is progressive. So if you're a married couple filing jointly and you make $94,000 a year or less, your long-term capital gains tax is actually 0%. If you make between $94,000 and about $590,000 a year, you pay 15%. And anything above $590,000, you pay 20%, plus typically an additional 3.8% net investment income tax, for a total of 23.8%. So this proposal would add basically a 4th bracket there for people who make above $1 million to have a long-term capital gains tax rate of 28% and an increase of that net investment income tax to 5%. So a total of 33%. That would be the highest long-term capital gains rate that we've seen since 1978. So almost 50 years, it would increase that capital gains rate tax. Again, this is going to shift incentives away from growth and innovation investing. And under our current capital gains system, investors are highly incentivized and rewarded for investing in high growth companies because they don't have to worry about income taxes. If you invest in safer or more value-oriented investments, yes, you're taking less risk, but those investments typically pay an income stream. And if you are a person who makes $1 million a year, who has a high net worth, a large amount of taxable assets, your taxable portfolio can start to create a larger tax burden to you than even income earned from working or owning a business. And so when under the current capital gains system, those investors are rewarded if they choose to invest in higher growth assets, because you don't have to pay taxes until you choose to sell. And when you do sell, you're going to pay at a lower rate than you would have if that was considered income. So if we implement this policy, then that's going to shift incentives away from growth and innovation investing, which is one of the areas that has allowed the United States to become the economic powerhouse that it is. Our free market capitalist society has allowed those growth and innovation companies to grow and really affect our economy as a whole. The other piece here too is a potential sell-off if this is not retroactive. Like Max mentioned in the 1987 saving and loans crisis, that was a policy that got implemented overnight, and it created a pretty massive effect in the markets and the economy. It didn't last forever, but it was a whipsaw reaction. If this is actually implemented and it is not a retroactive policy, then we can see some of these millionaires, these people who make more than $1 million a year, decide, you know what, I'm going to go ahead and capitalize on the long-term capital gains I do have. And that can create a technical sell-off in the market. Could be short-term, could be long-term, we wouldn't know, but it could lead to a sell-off in the end. The third policy here is a ban on grocery price gouging. So now we're moving into the least likely areas. And I'm going to spend some time here because I think that understanding this is pretty important. So we put this at a likelihood of 2. The reason why this has become such a large topic of conversation is that over the last 3 years, we've had significant inflation in the United States. We've seen inflation unlike anything we've really seen over the last 50 years. And one of the areas that has really affected the pockets of Americans are grocery prices. Just speaking for myself personally, I live alone. I have 2 dogs, and between my dog's food cost and my food cost, that has basically doubled in my budget over the last couple of years. So this is an area that has become more expensive and is becoming more recognized by folks as having an impact on their monthly budget. That is not due to price gouging, however. That is just due to inflation. And that's what inflation does. It makes the price of goods and services more expensive. This particular policy would apply to essential goods during emergencies or times of crisis. This is a policy that is already implemented by 37 states. So this would be a national implementation versus leaving it to the states to decide whether they want to implement that and when they decide to implement it. But a couple of things here. First, it potentially destroys grocery industry and favors a few big winners. As Max was mentioning before, when it comes to price controls, if we set price controls, then the only people who can afford to stay in business long-term are those who have margins big enough to have their margins squeezed based on a control of prices. So smaller grocers, mom and pop shops, this basically guarantees that depending on how long the price controls are in place, these businesses would go out and leave us with a few big winners who could afford to stay in business. But also, if we think about how prices are controlled under our current free market society, it's based on the laws of supply and demand. If we think about a time like Hurricane Katrina, gas prices got pretty high. And they got pretty high because there was a significant decrease in supply due to the fact that you couldn't even get close enough to New Orleans to supply gasoline. And so prices went up. In the normal supply and demand dynamics, what happens is that the higher prices encourages more suppliers to enter into the market And as more suppliers enter into the market and add supply, it decreases prices and prices normalize over time. If you set a price control there, then what you're virtually doing is you're destroying any opportunity for new supply to enter the market. And you can actually get to a point where the prices are controlled, but now we absolutely have no supply. And unless you're going to require also that suppliers supply the market, which is a whole other thing entirely, it can create more issues in the long run than it can solve problems. Last thing here is that it reintroduces the dangerous precedent of price controls. Again, we live in a free market capitalist society. That's just the way that our economy is structured. When we start adding things like price controls, which already exists in the healthcare space, which is something that we actually covered on a previous Beyond the Noise topic, that further moving down that path is not something that I think would benefit us given our free market nature. Last thing I'm going to cover here is an unrealized capital gains tax. We put this at a likelihood of 1 just because it could be so economically devastating and create so much confusion in markets in the short and long term. But this would be a 25% unrealized capital gains tax for centimillionaires. So those who have a net worth of over $100 million, they'd be required to pay, they'd have 9 years to pay that additional tax, which drops to 5 years after year 1. As I've mentioned in the last 3, this really shifts incentives away from growth and innovation investing. One of the highest growth investment opportunities we have in the United States is in venture capital. That is investing in companies that are small, but potentially have a very high opportunity for extreme growth and to grow into a mature large business. Venture capital investors are familiar with the risk there. It's estimated that about 40% of those investments will go to zero. So you're taking a significant amount of risk for the potential for a significant amount of return. Think about being able to invest in a company like Facebook before they even went public. That's the kind of growth opportunity that you're talking about in the venture capital space. If you're required to pay an unrealized capital gains tax, then you are highly disincentivized to invest in high growth companies. If I know that I'm going to have to pay 25% on growth that I earn in a company that I don't even plan on selling, don't want to sell, that's going to be a huge hit to my potential return long term. And from a risk perspective, from a risk reward perspective, it actually might make sense for me to just invest in a value company, a more mature company that pays me income over time, and I don't have to worry about this unrealized tax. So again, definitely shifts incentives away from growth and innovation investing. It also leads to this question of what happens if you have an asset, you have an investment that does go to zero? Do you end up having to pay taxes on a company that doesn't exist anymore? Where do you get the money to do that? You can't even sell shares of the business because those shares have no value. How is this going to be valued? Is it at the end of the year, the beginning of the year, an average? So a lot of questions there. And also potentially forces sales of private assets early, which hinders growth. So with that, I'm going to turn it over to Josh to discuss 3 policies for Trump.
Thanks, Laura. Okay, let's start off with the first one. So as a reminder, the comments that we're making both on Harris and Trump's policies are meant to be our honest evaluation of what their impact would be on the markets or the economy. It is not meant to be an endorsement or condemnation of any of them in a specific order. We're really specifically interested in what do we believe the impact will be on the markets and the things that most directly impact your investments with us. So with that in mind, let's dive in. So the first area that we have for Trump is tariffs on all imported goods. Trump's policy currently, as it's stated, is to put a 20% tariff on all imported goods and a 60% tariff on all imported goods from China. We would rank of the economic proposals that Trump has on the table, this is probably one of the higher likelihood options. It's still probably middle of the range, simply because some of these things could be implemented by the president alone. And and slash have also some bipartisan support in Congress. There's two major impacts that I think are important to identify here. First off, we do believe that the implementation of tariffs will be inflationary. What are tariffs? Tariffs are when you ultimately put a tax on a good before it enters the country. For specifically areas that the U.S. is not as competitive in, that all that's effectively going to do is result in a 20% increase in the cost of those particular goods. Now, there will also be some goods where maybe the U.S. is marginally less competitive, but the tariff puts the Americans back in a place where they can compete. But in most of those cases, most of those situations, it's still going to put the U.S. in a position where the cost of those goods are going to go up. The second point, I think this is the most important piece, is that it is unlikely to meaningfully improve Americans' standard of living. That is not to say that some of the industries that have the tariffs may not see wages go up, and you may have some isolated industries that are better off as a result of the tariffs. But on a broader scale, it will most likely result in prices moving up and overall standards of living either remaining the same or going down on that side of things. So that's the first policy, which is tariffs. The second policy is lowering the corporate income tax from 21% to 15%. We put the likelihood of this at a 2, mainly simply because these two things tend to be connected, which is the lowering of the corporate tax as well as extending the individual income tax cuts that were done in 2017. The first and major reason we believe that this is unlikely is that according to a Wharton study, it's estimated that this would result in over a $4.1 trillion of additional debt created over the next 10 years. So especially for Republicans, many of them have run based on not increasing the national debt. And unless there was also additional spending cuts that were incorporated, this would be a very large increase to the national debt over the next 10 years. As Laura mentioned, in the case of Harris, any situation where you increase the debt, you're likely to make interest rates remain higher for a more prolonged period of time, which has the impact of obviously our cost of debt as a nation being higher overall. And that also generally results in slower economic growth over the long term. Now, I will mention that typically one of the positive things that comes from tax cuts is that you generally see an uptick in growth. And a lot of people have even compared something like this to the times of Ronald Reagan, where he ultimately cut taxes. But there's one very important distinction to make between what would happen if this were to occur versus the time of Reagan. And that difference is, what was the U.S.'s economic growth under Reagan? At that point in time, it was in the 4 to 6% range. So as opposed to today, the average U.S. economic growth is somewhere between 1.5% and 2%. So roughly a third of what it was back then. And so because of that, when corporate taxes and individual taxes were ultimately cut under Reagan, that additional spending went into a machine that was growing at a much more rapid pace than what we are currently growing at. And so while we do anticipate that cutting taxes would have a positive impact on the economy, it also would not have as large of an impact as it did under Reagan, simply because the U.S. isn't growing at the same rate that it was back then. The third policy is, I'm sorry, I clicked one too far, is aggressive immigration policy. Specifically, as Trump said, he wants to carry out the largest domestic deportation operation in American history. We would put the likelihood of that as the smallest of these three, mainly because of two reasons. One, as Max mentioned earlier, it's the most moderate Congress member scenario. We're dealing with a Congress that is likely going to be a very narrow margin, and something like this would require an action by Congress in order for it to ultimately get implemented. There's a number of very moderate senators as well as House reps that have been very vocal in their opposition to this, so we tend to think that this is unlikely. However, if it were to happen, we think there would be two larger impacts. The first of which is it would be very inflationary, as most of the illegal immigrant population is part of the low-cost labor in the U.S. We're already dealing with an unemployment rate that's one of the lowest in American history. And as a result of that, we do believe that removing 8 or 9 million of these low cost laborers would result in the cost of labor going up, and therefore result in the cost of prices of goods ultimately moving up. And then the other thing is it would also probably also increase the debt in the country, because this would be an extremely expensive operation to ultimately be able to execute on. Once again, not here to comment on other impacts that are beyond the markets and the economic side of it, but believe that those would be two of the most prominent impacts. So I do want to just kind of wrap up. We think that just from a bigger picture standpoint, the most likely outcome of this election is probably more of a gridlock kind of situation. If one of the parties has control of all three chambers, it is unlikely to be a large one. It's likely to be a narrow margin. And as a result, only things that have very broad appeal would likely get passed. And those are actually, honestly, some of the types of governments that the markets like the most. So from that standpoint, we tend to view things positively. But I want to go back to one of the statistics that Max mentioned earlier, which is if we look at market growth over a long period of time in which there were both Democrat controlled and Republican controlled Congresses, what we see is that growth remains good over a long period of time. And that's not to say that there aren't situations where politics can make a difference. It does. The illustration I like to use is if you had someone run a 5K, the kind of political government you have is like the equivalent of adding a 10-pound weight to a backpack that the runner is wearing. Does it impact the runner and their ability to finish the race? Sure. If you add 10 pounds to their back, it will impact things. On the flip side, a good government could be the equivalent of taking that 10 pounds out of the backpack. So it does have an impact. We don't want to shy away from the fact that it does. But the real key to the US's strategic success for 200 years on the economic and investment front is the fact that we have innovative, hardworking people that continue, despite the political environment, to deliver really compelling products and solutions to their customers and continually seek to innovate. That is the backdrop that is still there, and it's the backdrop that has allowed the economy to do well under both Republican and Democratic controlled governments. And that's the reason why longer term we feel positive about the outlook, even though during the short term there may be some tailwinds. There may be some headwinds that we may encounter. And so with that, we'll open it up for a few questions. We know we've gone over a little bit today, so we will keep those short.
Well, actually, there are no questions at this time. So
well, we will keep it short then.
That will be very short. So, and our time is up as well. So thank you to our presenters, Max, Laura, and Josh. Have a great rest of the week, and we look forward to seeing you at the next Beyond the Noise webinar. Thank you.